This week, the U.S. Federal Reserve lowered interest rates for the first time since 2020, slashing half a percentage point off benchmark rates. For our weekly focus this week, joining me in the studio to discuss this is our economics correspondent Moon Hae-ryun. Welcome, Hae-ryun.
Thank you for having me.
Thank you for your time. So, Hae-ryun, let's first talk about what was announced during the Federal Reserve's meeting on Wednesday.
Well, as you said, Yujin, the Fed announced that it would be lowering interest rates by 50 basis points to bring the benchmark interest rate down to the 4.75 to 5% range. Half a percentage point may not sound like much, but it's considered a big step. Other than the emergency reductions made during the COVID-19 pandemic, it's the first time since the global financial crisis of 2008 that the Fed has slashed rates by such a significant amount. And what's more is that Fed policy makers also projected further rate cuts worth 50 basis points in the coming months, signaling confidence in its ability to manage the economy.
And what was the reason behind the Fed's decision?
Well, since July last year, the Fed has been keeping its benchmark interest rate at a two-decade high in an attempt to tackle inflation. And over the past few months, inflation has been falling, reaching 2.5% in August and getting close to the Fed's target. But high interest rates can hold back hiring, and recent figures have shown rising unemployment rates. This decision from the Fed therefore shows a shift in focus from inflation to addressing the U.S. job market. And here's what Fed Chair Jerome Powell said.
This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Right. So what effects could this have on the U.S. economy?
Well, the benchmark interest rate sets a standard for both borrowing and deposit rates. But lending rates are more competitive, meaning that they're more likely to move. Borrowing rates include things such as mortgages, car loans, and other debts such as unpaid credit card balances. In anticipation of the rate cut, mortgage rates have already fallen in the U.S., reaching a two-year low, which will provide relief for home buyers. And as I mentioned before, interest rates are being lowered in the interest of rejuvenating the job market, which recently saw unemployment rates rise to 4.2%. But experts say that monetary policy tends to have a time lag, so we'll have to keep an eye on the situation to see what happens.
Also, how have stock markets responded to the rate cut so far?
Well, market reaction on Wednesday was relatively subdued, the S&P 500 closing 0.3% down as traders digested the Fed's decision. Here's what an expert said about why this was the case.
This type of the aggressive cuts and also the long-term plan for reducing the rates kind of, make investors and market participants actually start suspecting, well, maybe they're aggressively lowering this because they're expecting the slowdown economy or even recession. Therefore, there could be some in a short-term fallback or pullback of the stock price.
And it was a short-term fallback. The U.S. market saw a surge on Thursday as traders digested the Fed's decision and began placing their bets on a soft landing. The Dow Jones Industrial Average and S&P 500 both closed at a record high as they climbed 1.2% and 1.7% respectively, while the tech-heavy Nasdaq showed even bigger gains of 2.5%. Lower interest rates tend to lead to a bullish market, especially for high-growth sectors such as technology, as they encourage economic growth and investments in riskier assets.
And last but not least, let's talk about South Korea. How could this rate cut affect the country's monetary policy?
Well, Yujin, the Bank of Korea's next interest policy meeting is due to take place next month, and there are several factors that are weighing in on their decision. The U.S. pivot in monetary policy is one of them, and it's expected that the rate cut could add weight to BOK decision makers to also cut rates. But experts say that the BOK will be looking for domestic economic indicators to make their decision, particularly the recent surge in household debt alongside weak domestic demand.
I think they will see whether the household debt and housing prices continue to grow because they have about a month to make their decision. If the household debt and housing prices keep on rising, then Bank of Korea may decide to not cut the rates at all or only cut the rates by 25 basis points rather than 50 like the U.S.
The Bank of Korea also commented on how it expects the rate cut to have a positive effect on the foreign exchange market. Generally speaking, high interest rates boost the value of currency, as we've seen reflected in the soaring US dollar in contrast with the weak Japanese yen. With the rate cut, currencies such as the Korean won are likely to rise against the dollar.
All right, thanks for the wrap-up, Henry. We really appreciate it.
My pleasure, Eugene.